So I hope you all had a relaxing evening, 2 exciting days at DLD so far, and hope that you made it through the party last night. I think in the last couple of days we heard a lot about the acceleration of the digital transformation, its implications for consumers, for businesses, for art, health, society, and its influence on politics. Now we want to zoom in a bit to what we do, which is venture capital. So it's one of the lubricants of all that ecosystem. We shouldn't overestimate its influence, but we also shouldn't underestimate it. 2015 has been a good year for venture capital in terms of deal flow, invested capital, and I think also in terms of fundraising, so the coffers are full. On the exit sides, we have seen some great private transactions. We have seen some IPOs that performed very well. We've seen some IPOs that disappointed a bit. It feels like in the last 12 months, actually, quite a few things have changed. I think we've seen, on the one side, not a burst of a bubble, but we've seen a few expected next things that just didn't happen, so they underwhelmed us a bit. The Internet of Things has been slow in consumer adoption. Virtual reality has not entered the mainstream yet. Blockchain has to produce yet a killer application, and machine learning is a very powerful idea, yet it only plays so far for the guys who have already big data pools in their possession. Other things have surprised on the positive side in terms of speed of adoption. FinTech has made great strides towards broader consumer and business acceptance. Autonomous driving is much more real to many than it was 12 months ago or 24 months ago. And things like same-day delivery, so kind of the question of the last mile and logistics, has entered the phase of mass adoption. On a more general level, it seems that last year the omnipresent notion of the unicorn and our fascination with it is fading quickly. It always felt kind of a difficult concept to have a benchmark, a general benchmark at which a company would be part of a special club that could only attract people and money when you get there. So it seems that now it's been replaced by probably the old notion of that most companies have a right size and not necessarily have to perform to one yardstick. So what will 2016 bring? That's kind of what we want to do on our panel. And let me introduce 4 of my peers, and I'm very happy that we together will try to take a crack at a few questions. Let me start with the lady in the group, Avid, Larizadeh Duggan. She's a general partner of Google Ventures. Prior to Google Ventures, Avid founded Botica, a global marketplace for independent brands of fashion accessories. She has been involved in the startup ecosystem since 1998, and she started investing at Excel Partners in 2006. And she also had product management roles at Tell.me, Networks, eBay, and Skype. Investments include Resolution Games in Sweden, Lost My Name in the UK, and Yieldify also in the UK. Welcome.
Thank you. Thank you.
T.Schipporeit, he is leading Index Ventures efforts in the German-speaking, so in the so-called DACH region. Prior to joining Index, Tim spent 12 years at Morgan Stanley, leading its software and internet corporate finance team for Europe. During that time, he led major M&A and IPO transactions. At Index, Tim invests across all stages of the venture spectrum, from seed to growth stage, and out of 2 separate funds. Investments in Germany include Ox Money, Dubsmash, Nawabi, Saving Global, and SoundCloud, and most recently, and you probably heard about that, Movinga. Welcome.
Thank you.
N.Marovac is a veteran of our industry with more than 20 years of venture capital and private equity investment experience. He's the founder and managing partner of DN Capital, which was founded in 2000 and now has operations in London, Silicon Valley, and Berlin. Nenad focuses on investments in e-commerce, marketplaces, mobile and digital media companies. And amongst his investments, amongst his many successful investments are Shazam, AppSmart, Endeca, Mr. Specs, Quandu, and Windeln.de. Welcome.
Thank you.
And last but not least, T.Stafford, who is a partner at DST Global, a late-stage internet and technology investment firm. Tom runs DST's European and fintech efforts. Tom and DST are believers in the global nature of internet and technology, and Tom splits his time between Asia, US, and Europe. Over the past 12 to 18 months, DST has led investment rounds in a number of European companies, and among the ones that are disclosed are AutoOne, Funding Circle, Farfetch, and Deliveroo. So about this panel, very quickly, I think we want to discuss 3 topics. The first one, I think, is the obvious one. So what are things that we think, as this group, what are opportunities and global themes that are ripe for investment and ripe for acceleration? Second, we want to do a little bit of introspection of what's happening with the venture capital industries, or what has happened over the past 12 months, what we see kind of trends going forward. And last, we want to take a crack at how is Europe doing in VC? Not so much versus what the US is doing, but in terms of general and seeing where Europe has, how has Europe developed in the past 5 years and what's next. And once we're done with that, then I think we're more than happy to open the floor up to questions. So what are global themes? And I probably start with you, Nenad. What are, if I remember, like the buzzwords of the last couple of years, e-commerce, mobile, social, big data, just to name a few. We have seen a lot of new consumer and also small business themes coming online. What trends do you currently see? What are companies that excite you? And where do you see kind of the next wave coming from?
Yeah. So at DN, we split our team into different segments, and I cover marketplaces, e-commerce, mobile, and digital media. And obviously, some of the things I love are putting digital together with the physical. So one of my latest investments is a company called Happen. I don't know if anybody knows Happen in the room, or you won't admit it, but basically, this is a new dating app which is based on geolocation. So if you pass someone in the street, basically, if they're on the app, then you can also connect with them. And this business has gone from 0 to 10 million users within 10 months. And the curve is like this. So putting anything physical together with digital is something we do a lot of. We're looking a lot at virtual reality. We continue to invest in Germany quite heavily in the marketplace sector. We're the earliest investor in a company called AutoOne, which is actually wir kaufen ein Auto, so you can take your car and actually will buy your car. And before your car has already been on our lot for half an hour, we have a marketplace of about 15,000 dealers which will be bidding on your car. In many cases, your car is sold before you leave and you take a taxi home. So that's another, just applying technology to physical businesses and actually creating new business models like AutoOne, like Happen, et cetera.
Okay. Avid, I think you're investing, you're probably the earliest in this group, together with Nenad. We'll probably also have you as number 2.
Sure.
Take a crack at that question.
Good morning, everyone. So we invest in all stages, really, mostly starting from A's and B's and C's and D's. And the way I like to look at this question is looking at what will happen in 5 years from now. What will the world look like? And 3 things come to mind. One is that the web will have fully shifted to mobile. Networks will be much faster, and they will be faster globally. And I think cloud computing will become completely ubiquitous. And so what that means is, in terms of the impact it has, it means that we'll be able to access massive amounts of data from anywhere we are at a very rapid speed. And that has impacts, very positive impacts, on all the industries that we look at today and that we invest in today. And if I were to name 4 where I am interested in, that GV is interested in, one would be e-commerce, but not e-commerce platforms themselves, the ecosystem around e-commerce, that the tools that enable that. So from better shipping, fraud prevention, optimization, and all of that through machine learning and better understanding user behavior and providing a better user experience. And again, it's the massive amounts of data and the rapid pace at which we can analyze it that enables us to do that. Another one, which is very dear to our heart at GV, is life science. And last year, we spent about 30% of our investment money into life science. Our plan is in the next 5 years to deploy about $1 billion in life science. And again, you see that trend of data already. Massive amounts of data being able to be analyzed quickly, provide a lot of advances, whether it's in genomics, whether it's in all the realms of healthcare, drug discovery. And then very quickly, the last two I would say is security, and we've seen that already, but fear is a very big motivator for people and companies. And again, lots of data available means lots of ways to prevent the wrong people to access this data. And finally, one that's very near to my heart is VR. And I think we're starting to see the beginnings of innovation in VR. But it's very early days. We see it applied mostly in gaming. But it's an industry that's going to, with VR and AR, have impact in travel, in healthcare, in education. And in the next couple of years, as the technology matures, I think we'll see even more innovation in that space.
Tim, you want to?
Yeah. I think we continue to focus on our 4 key themes, which are really mobile consumer, marketplaces, enterprise software, and fintech. I think gaming, I would say, I would add somewhere there. It had been a super successful area for us over the last couple of years with King, Supercell, a couple of others. And then there was a view that maybe gaming is not so interesting anymore, where it's hard to exit, it's very lumpy. But exactly as you just said, I think the advent of VR and AR is really leading to a renaissance of gaming and what can be done, and also broadening the audience for gaming. So it's one we're spending, again, more time on these days. I think in marketplace in particular, and obviously Europe, in our view, is slightly more geared towards the whole B2C rather than necessarily enterprise in terms of investment opportunities. We look at a lot of replatforming of existing consumer services. So you mentioned our investment in Movinga. I think that probably applies to lots of other verticals as well, whether it's painting, it's moving, it's obviously, we had it in food delivery. So lots of consumer service, you had it in selling your cars. I think there are a lot of new marketplaces still emerging in sectors that you would assume are really mature, but I think where still a lot of innovation can happen through kind of really...
So vertical services?
Exactly.
Okay. Tom, you probably are kind of the guy that deploys the most per company in this round, so you're a little bit later on. So for you, companies do not only have to be small and fast-moving, but they also have to reach a certain scale, and you told me that if it's not a global business, it's probably not like the core of what you're looking for, right?
Yeah, I don't think it has to be a global business necessarily. I think it needs to be globally competitive. Right. So we analyze and think about companies in a global cohort, not a local cohort. But on the topic, I guess I think about the market we invest in 3 ways, or 3 segments. The first is a very simple one, which is there's a $46 trillion consumer spend in the world today, going to grow another 20 to 25 trillion over the next 10 years, particularly as the emerging middle class comes out of China and India. So when we all think about the advent of internet, many people start saying, oh, what's the next sector that's going to emerge, and what's going to happen, and how are we going to make a bigger market cap over the next 10 years? And I take a very simple view, which is we're only scratching the surface. $46 trillion of consumer spend today, and a very small percentage, a couple of very single-digit percentages of that actually even touched by internet and technology. So I guess my core focus is still looking at that $46 trillion of consumer spend and thinking about what are the top sectors: housing, utilities, transportation, financial services, apparel and consumer care in the e-commerce world, and of course fintech, and increasingly healthcare. So that's the first piece, is just looking at that large consumer spend and trying to see how does it get disrupted, what are the most efficient ways to disrupt it. I think that the second thing we look at is when you bring across a consumer and you look at SME and indeed enterprise, many of the lessons we've learned over the last 10 years of internet growing in consumer haven't yet been learned by enterprise or SME-focused companies. And so what we're really looking at is companies that take the lessons of a lending club, take the lessons of a Facebook or a Twitter, take the lessons of an Airbnb or an Uber, and apply that in SME and enterprise. And those lessons are easy access, both to the utility of the application as well as to the underlying data. And it's the lessons around how do you go to market and how do you do it in a very efficient way and get some virality to your marketing. So this is the second theme, is really taking consumer learnings into SME. And then the third thing I look at is what is happening today that can influence 5 years out our investment decisions. And I think for us, it's many of the things we talked about, but primarily it comes back to data and algorithms based on that data. And ultimately, if we as human beings want to advance and improve our utility as individuals, but also most importantly as society, we're not going to be able to do it with our own brains. It's going to have to be a combination of the way in which we think and work, as well as support and utility being drawn from the data. And that utility is most likely to come through mathematics and physics, i.e. algorithms and AI. And that's something that I'm very focused on and find very fascinating, notwithstanding all the issues that it brings, but I think it's the only way we're going to actually increase utility over time.
So if we take that in summary, I think if we look at those new things coming, there's also a realization that probably we over-allocated funds to some industry probably in the last 18 to 24 months. So for example, 12 months ago, I think food was kind of the big craze everywhere, right? None of you mentioned food now. So is food, it's still a huge thing, right?
It's still a core of our investment thesis. We're extremely large investors in Just Eat and still big investors with Tom also in Deliveroo. So we like the model. I think it fits the kind of re-platforming of consumer services, marketplaces, and it's a tremendous industry. I think what one needs to be careful about is kind of how many different models can there be, what is really disruptive, what is really improving the consumer proposition and potentially the supplier proposition, which I think Deliveroo is a great example of. But I'm sure there are many others that touch a smaller opportunity that can be innovative. But I think we are focused on opportunities that are really large and can scale globally, which is what Deliveroo really does.
And I would say, I just add to that as well. First of all, food is the 6th largest portion of global consumer spend. So it's, again, we've only just touched the surface. But I think the thing that fascinates me about it is that although we've all deployed quite large amounts of capital, first of all, it's irrelevant in the context of the market capitalization that will be created in food, in internet. So, while some people might lose on one individual investment, as a cohort, food will be one of the largest creators of market cap over the next 10 years. The second point I'd say is that we've all mostly been investing in things that touch just the last mile of food, either from the restaurant to the consumer or from the supermarket to the consumer. None of us yet, I don't believe, have touched the back end of food, which is actually where there's probably more efficiency to be created and more interesting profitability to be created. What I mean is where the food originates from the farm, from the fishing vessel, from perhaps the first manufacturer of crushing down the wheat, etc. And how that gets from that very early stages of the ecosystem all the way through to the table, I think is actually the most interesting thing in food to my mind. And we're just scratching the end, the last mile. And I think one of our themes at DST, certainly for Europe and also for China, is ecosystem efficiency. We don't yet have that in any one of our ecosystems, whether it's in fintech, transportation, and certainly not in food, because we don't have from end to end efficiency yet, and that's the big opportunity.
So we have, sorry, Nanette, we have invested and are looking actively at food technology. So Impossible Food is an investment, for example, that we made out of the US, and we have a partner, Andy Wheeler, one of his focuses is exactly that, food technology.
I guess if you look at companies like Deliveroo or Book a Tiger, et cetera, these are really fragmented business where people were operating on their own. But through technology, with the speed, as Avid was talking about, you're able to get that food from a restaurant to someone's home via a bicycle that's not even owned by the Deliveroo or Take It Easy in our case. So just using the technologies that are coming out You mentioned Movinga. Movinga is basically, you want to move. Moving is just, there's like 35,000 moving companies in Germany. You just basically using technology to get all these fragmented industries. And so, we just see more and more in that space. On Movinga, you talked about the car, taking used car dealers, et cetera. So taking archaic, fragmented industries and putting technology in place so that actually you can operate these businesses. I mean, obviously Uber is the most classic example of that, but that's kind of where we see a lot of interesting opportunities going forward. And obviously as the networks speed up and the accuracy increases, we're going to see more and more new business models coming from that.
Okay. So if we then take a minute to talk about what the VC industry itself has been going through, and I don't want to spend too much time on it, but I think we've seen a few things, like large funds have been raised in the past 12 months. A lot of new entrants came to the scene, especially corporate VCs, especially here in Europe, like talk of corporate VCs have spun up. How do you see the ecosystem evolve, and what will the implications be for entrepreneurs? So are we going to see the dying of fringe players? Are we going to see the emergence of new players? How do you see it play out?
I think there is, I would say, overwhelmingly positive development, right? Which is not a big surprise. You had obviously larger and larger funding rounds, more exits, larger companies being built, larger companies being exited, whether it's Zalando, whether it's Rocket, kind of Just Eat, King, just to name a couple that went public, right? So you had these multi-billion outcomes. So that leads to kind of serial entrepreneurs who then also oftentimes somehow over-allocate part of their wealth to kind of, again, the tech sector, because it's part of what they're really interested in, and it's really them giving back also to the ecosystem. So I think on one end, we've seen a lot of kind of early stage new seed funds coming up in Germany of guys like Cherry Ventures and others. Kind of, I think even in Berlin, you have 5 or 6 new funds just on the early stage, and similar developments in London. And then I think you have, as you rightly say, on the other end, a couple of actually pretty large funds, kind of very new funds, like EQT has just started EQT Ventures. I think is a pretty significant fund. You have T Capital with a very significant fund. So those obviously add to the funding ability. So I think for the European entrepreneur, it's overwhelmingly great news. I think it also means that obviously there is way more ability to fund more ambitious stories and funded in Europe predominantly, and over time, then once companies become very large, needing to tap the US market, but really being able to fund companies pretty much everywhere. And I see that in Germany, I see that in the UK, Spain, and other markets. So
does that mean that funding is not scarce anymore, or is it scarce on certain levels?
I don't think it's, from my perspective, I don't think it's scarce for a great opportunity for a great company and for great entrepreneurs. I don't think it is these days. So I think it's actually very ample. I would say even in the seed and probably pre-IPO, you could even argue it's potentially in abundance.
I think there's a shift going on, and I think part of it's generational. I think some of the funds that actually never got to real critical mass, smaller funds, 100, 150 million, where they might have been fund 2, fund 3, the older guys have not given economics to the younger guys, and obviously you've seen a lot of the younger guys spin out to Blue Yard, a couple other firms in London. And so those older firms are now, their talents left. The older guys are there and they're sailing a lot or doing whatever. And probably there's going to be a big shift, I think, in the marketplace. Obviously, guys like Index, Accel, which are big firms, have that generational sort of succession planning already in. But unless you have a big fund, it's hard to actually afford to have that generational layer in the fund. So I think you're seeing a big shift. Obviously, some bigger funds, Lakestar, Atomico coming in, but really at the later stage, I guess competing more with you, Tom. But at that early stage, Series A, traditional Sequoia, Silicon Valley style investing, there's not that many firms that actually are doing this and can go all the way through the company. A lot of people want to, basically wait till the Series B and then, get the great companies. Well, that doesn't work. If you want to get the alpha, you have to go in early, like people like you are doing, like we're doing. So I think it's going to be interesting to see how it plays out. Obviously, some of these new groups, the guys will, Cherry is definitely going to go in Series A, a lot of the new Berlin funds. And one of those guys will emerge as the new Index or Axel of Europe, because these guys are talented, they're very well connected, and they're very smart, and they're working hard. So I think it's going to be very interesting.
So basically, Tom, you can't really make money, right? Because you don't go in that early. How do you do it?
I don't want to give away my secret sauce.
He's got a big checkbook.
Look, my view is that I go back and repeat what I kind of said earlier, is we all tend to think in very short time horizons, no matter how much we try to force ourselves to think longer. None of us can think, and I don't believe I've ever met a single person that can think exponentially. And so when you look at companies, you look at business plans, if it's a great company in a big market with a great team, it's never too late. And therefore, it's never too late to make money. And that applies to whether you invest at Series A, it applies to whether you invest at the stages we invest, it applies to whether you invest in the public markets. So I think there's always opportunity to invest in great companies and great teams. And I think to Tim's point, there's been very few points in history, 20, 30 years of history in the financial markets, private and public, that great companies cannot get funded. There might be a 3-month window, there might even be a 6-month window, but there's never more than a 6-month window that great companies can't get funded. I think what we're seeing right now, on top of everything you've talked about in terms of the generational shift, the new guys launching, is actually just a realization that winners do tend to take the majority of profits in the industry we all invest in. And backing the number 2 or number 3 player is not generally a great investment thesis. And I think people lost a little bit of sight of that, or perhaps were excited about investing in themes and sectors rather than individuals and companies. And I think we're getting back to basics of not only do you need to be excited about the thesis, not excited about the sector or the vertical, you need to be excited that this is the number 1 winner on a global basis, by the way, globally competitive. Because if you don't, you're not going to make money as an investor. It has to be globally competitive.
But now I think we're having a discussion that it almost sounds that we're independent from capital markets and kind of what's happening out there, right? And a few things have happened since the 1st of January. And I think probably more things to come. How does that influence us as an industry? So now the funds have been raised on past successes, as always. Now we see there's an abundance of opportunities. So the basic opportunity is still there. But how do we see that play out in terms of where capital markets are moving us? Are we totally independent from that? In terms of valuations and what we accept and what we're going to do?
I don't think we're independent. I think Europe's might be slightly different from the US because of the difference in valuation. So there was a much higher hike in valuations in the US than we have seen in Europe. So the impact might be different. But I think if we look, and we've heard it a lot yesterday, in terms of the capital markets and the macroeconomic events that are happening that are outside necessarily of the tech industry, but that affect our public markets, which will have effects on the later stage investors, whether it's hedge funds or others that are coming and funding these companies, who may retreat a little bit, and that will have trickle effects all the way back. It doesn't mean that suddenly there won't be any capital at all to invest. I think just people will be more cautious. There's also an increase in the cost of capital. As if you look at the Fed, if it continues to raise its rates, then that'll also impact that. And so what has been very easily done in the past couple of years in terms of raising a lot of capital won't be as easy. So again, caution, where I think both entrepreneurs and investors will think, okay, we're thinking about getting to sustainability much faster. How do we, use our cash in a more efficient way? And the time horizons in terms of getting to that break-even point or seeing the sustainability in the foundations of the business.
Is that one of the themes in 2016, getting to more sustainability of your company and kind of getting to looking at the numbers, looking at where at the end money is coming from?
Listen, I would hope that this is a theme overall every year for every investment we make, because ultimately none of us, I think, want to invest in a business that is not sustainable and doesn't have the right foundations. But I think that there might be more of an emphasis on that, and especially companies that have very large war chests today. and that can sustain sort of ups and downs. And we have cycles all the time. Will just potentially shift the way they manage their budgets slightly differently than when capital was a lot easier to access. And we see that already, without naming names, in terms of some companies that are great companies but are having a harder time raising the amounts of capital that they want to raise.
But I think you need to differentiate also. There's really sentiment psychology, right, which always influences investors in the public and private markets, sometimes rightly or wrongly. But I don't think necessarily a 10%, 15% shift in the markets should, as a core VC investor, shift your way how you look at the world, right? Neither in terms of what a great company is, not really in terms of valuation, because a 2 million valuation delta at a Series A will really not make a difference to your investment down the road. I think, second of all, it's somewhat irrational actually to take these market swings as an early stage VC investor into account, because who knows what will be happening in 5 or 7 years down the road, right? Whether we'll have an open IPO market, a closed IPO market, where IPO valuations will be, whether it's in SaaS or consumer internet. So it's somewhat irrelevant. It's always kind of a benchmark, but I think it's less relevant for the early stages than it is probably for what Tom or other people who are actually even later stage than Tom go in, really the kind of institutional funds who do the pre-IPO funding. I think those, obviously, but we have seen that correction already play out over the last 12 months. We had a lot of pre-IPO investors demand very structured deals, ratchets, and so forth. So if the IPO price is below the price they came in at, they get additional shares and all of that. And I think we've seen a slight cooling of that pre-IPO investment.
So it will have some impact in terms of, at the end, to the ecosystem. You just say, of course, you shouldn't, but we also know from the past that usually VC moves in cycles, right? So that you would expect fundraising to get more difficult. Once the general market comes down, fundraising gets more difficult. And actually then probably that's exactly what you alluded to. Probably the best entrepreneurs are probably on the market, right? And they still need to get funding.
Look, I think I get really disappointed when VC as an industry starts talking about we're going to focus this year on great companies that are sustainable over time, because we should all be shot and fired by our limited partners if we haven't been doing that throughout the fund life. The fact is, the core of everything is great team, big sector or vertical, and unit economics that make sense. That should never change, whether it's 2016, 2006, or 2026. And so those three factors together decide where you should make an investment. To Tim's point, I think as you go later in the investment, the world, i.e. Series D, E, pre-IPO, clearly you have to look at the cost of capital, the time value of your money, and where you're coming out to IPO or exit. But the core of a decision, investment decision, ignoring valuation, should always be in the three first factors. And they're the reason why you should want to invest and you should make the investment. Then there's a strategy of, well, when am I investing now? When am I going to exit? If it's 1 year, I need to take into account current markets. If it's 7 years, there isn't really much point in taking into account current markets. And I would say the other thing that we've obviously seen, and Tim has very rightly said, is the pre-IPO market has calmed down or pulled back. But that's actually happened like 9 months ago. That isn't happening now. That's already happened. The mutual funds, the public markets guys who bluntly aren't dedicated to the sector, they play in it when they can't get alpha elsewhere. They've come out of the market, but that happened 9 months ago. So I don't think there's going to be some sort of incredible shift over the next 3 months.
But is that an implicit expectation that there will be no IPOs or a lower number of IPOs?
Or maybe the pricing expectations shift. I mean, obviously, since last summer, I think you've definitely seen jitters in the market, the pricing. I think we're back to a situation where, there's going to be a lot less hype in the market, and the companies that were really hyped and the entrepreneurs just pushing valuation and playing the VCs off of each other to get it even higher. I think those types of deals are going to probably slow down and probably not show up as much. And then it's going to be back to work. And, as Tom said, unit economics, if the unit economics don't work, there's a lot of companies that raised a lot of money and they haven't proven their economics. And those companies in this market are going to have a lot of trouble. And so, but the good entrepreneurs that have good business models will continue to get funded, and probably even in our portfolio, we're seeing people actually just, they're not counting on that fundraising at a big valuation in June. They're saying we need to make this money work or get to cash flow break even sooner. And I think you're going to see a lot more of that in the market right now, especially if we have another couple weeks like we've had recently. but we've all been there before, right?
So where does that, so we're all parts of the European ecosystem. Where does that leave us? If we look 5 years back, 5 years in the future, is Europe developing a sound ecosystem for venture capital, or is it still a lot that is to be hoped that we will get it?
So personally, we're very excited about Europe and the European ecosystem. And for context, so I moved from the US, where I spent 10 years, the majority of which in Silicon Valley, in 2006 to Europe, to London. And in 2006, where I started initially in VC after being operational at Accel, compared to what it is today, is exponentially different in terms of the quality of entrepreneurs, the quality of VCs, the vision that people have, the ambition that these entrepreneurs have. And it's delightful to see. And also the ecosystem itself, the way that it's being built, helping each other, the transfer of knowledge. And then looking at it even as an entrepreneur. So before I joined GV, I was an entrepreneur for 5 years building my company. And from the entrepreneur side, looking at the VCs, there's been also a shift in there, which is extremely important for an entrepreneur, where you want to have VCs across from you who want you to build something big, who are supporting you through the ups and downs. Companies have cycles. They will have lows. They will have highs. Many companies that we love today that are extremely successful went through near-death experiences. And I think we're seeing more and more investors sitting here that know that, appreciate it, and also know the power of building these global businesses. And you see in Europe global businesses being built that are globally competitive, as Tom was saying. So we're very bullish on that. It's very exciting what we see. These are companies that are becoming winners in their categories globally. And we'll see more and more of these as more serial entrepreneurs come onto the market, and VCs like these, more of them with larger funds and bigger visions are on the market. So I think it's a great time and place to invest.
Sure. I think the last 5 years, actually probably since 2008, we've seen a massive shift in Europe. Obviously, you have Slush coming up in Helsinki. You have the Founders Forum, NOAA, et cetera, and all this ecosystem building that basically is getting people to turn down jobs at Morgan Stanley or McKinsey and come and do startups. I think one of the most important things that's happened in Europe is Rocket Internet. Very controversial, but what Ollie has created is sort of an academy for entrepreneurs. And so you look at sort of the companies that have spun out of Rocket. So Auto1, which I mentioned before, Home2Go, et cetera. All these companies are created by people that worked at Rocket for 3 to 5 years, and actually got to taste success in some ways, like Philip Magine at CDDeal, Hakan at Home2Go, but actually learned how to build a business at scale, and now are doing it on their own. And so I think this X sort of group of Rocket people, if you look at the US, you have PayPal, and PayPal has created lots of different companies. The only company in Europe that has done this is Rocket Internet. And so we are extremely bullish on the German opportunity as a result of what Rocket has done, controversial as it is.
Look, I'm excited about Europe, and indeed we've put our money where our mouth is. So 2015, we deployed more capital in Europe than we ever have before, and we have the appetite to do that again in 2016, 2017, and into the future. We see a couple of factors that make us excited. I think that the first factor is actually the recycling of capital and the recycling of knowledge. And this is partly the kind of the repeat entrepreneur, but actually also the entrepreneur, or indeed the executive at a company that becomes an angel investor. And I think my view of Silicon Valley is that its greatest ecosystem is the guy or girl who at 35 years of age has had an IPO, semi-retired, and becomes an advisor, a mentor, and an investor, an angel investor. And this is what has thrived in Silicon Valley, is people starting companies, getting 3 or 4, maybe even 10 angel investors to invest in the company, give them cash, of course, take risks, but more importantly, give them a lot of advice about, here are the pitfalls we made early, here are the things we did wrong, here's my network of connections, so you can hire the CMO very fast. You don't need to wait for 6 months to try and find that CMO, et cetera. And I think you're beginning to see that in Europe, and that makes me incredibly excited. And I think, for example, Movinga is a good example of that, which is the early investors in that company were actually, I think, 16 or 18 business angels in Berlin and elsewhere in Germany, all of whom added not just capital, but real value to the company. And indeed have continued on investing in the company since then. And that's one of the first examples, I think, of business angels or people who have made money in the ecosystem coming back into the ecosystem themselves, the next wave of companies, and really adding value. So with that, I'm very excited about the next wave. The second thing I'm really excited about is the growth stage that I mostly invest at, is when you speak to entrepreneurs today in Europe, compared to 10 years ago, they all think about Europe as a big market. And it used to be they all said, oh, look, we can build a business in the UK, it's going to be X big, maybe we'll pivot to the US to build a really big business. Now when you go in, the pitch decks, the conversations about 400 million people in Europe, nearly a third of global consumer spend, a third of the GDP, a third of the wealth. This is a big market. We don't all need to run to the US immediately to build our business. Indeed, working out how to go from the UK and into France, or France into Germany, is exactly the secrets you need to learn to go from France into the US, because it's cross-border, it's having different offices, et cetera. And I think people are now realizing that actually building a big business in Europe is doable, is just as big a market as the US, and actually trains you incredibly well to go very global.
So basically, it hasn't become easier, but you say just more people know how to do it.
Not more, just more people know how to do it. More people are ambitious enough to take it on. Supported by the VC ecosystem. You know, when I was investing kind of 10, 12 years ago in Europe, in the earlier stages, most VCs wanted to get in at below $5 million valuation equivalent and out at 20 to 30 million. That was the game, right? It was if you can make 5 to 6 times in a very short duration, say 5 years, flip the business in M&A predominantly to a US or other buyer of the company, that was a great win in VC land in the mid-2000s. That's not the great win anymore. Now everybody's saying, well, why can't I build a $1 billion business, a $10 billion business and beyond? And I think that's a great ambition level to have in Europe, and I certainly see it today amongst our portfolio companies and companies that we're looking at.
And I think that Tom's point, the recycling of capital, we shouldn't underestimate that. If you really think about the last 2 years, they probably were, in my mind, as good as it gets, at least for the time being in Europe. Hope Europe will further evolve, but if you just count the IPOs, right? You had in the UK, you had Zoopla, you had AO World, you had Just Eat, you had Rightmove, you had Autotrader, you have in Germany, you have Scout, you have Windel, you have HelloFresh, tried the IPO, you had Zalando and Rocket. So you had probably 10, 12 really material IPOs, all kind of billion-plus companies. That there was actually none of that between 2003 and 2013, except for Betfair and Ocado, really. In Germany, there was just nothing. So I think that also recycles a lot of capital into the VC community, into the angel community, into kind of executives, all the, Zalando founders, Rocket founders, all of them obviously having some capital to play with. And then on top of that, we have a continued good momentum on M&A exit. Supercell sold for $5 billion to SoftBank. Again, those founders there becoming very, very active angel investors. So I think that's just overwhelmingly positive, I think.
So that means that this crowd, very much to the surprise of everybody, is rather bullish about venture capital. So now for the bearish questions, I think we should turn to the audience and just ask if you have any questions to the panel or to panelists.
It's too early.
Everybody asleep?
Hi, my name is A.L.Duggan, Claro Partners. I wanted to ask if you see any fundamental changes to the business model of venture capital in terms of fees and things like that, let's say how you make money, or if you think it's going to stay the same coming years.
I think one change that we have seen and we are seeing now in business model, not in terms of fees, but is the resources that venture capital brings to the table. So, 10 years ago, it was about the VC partner and the partnership and the connections that individual had or the experience that one individual had. I think today you're seeing more and more firms who have a larger operational team. So we have about 40 to 50 operational people, from designers to engineers to product managers, recruiters, who are dedicated to helping our portfolio companies. I know Atomico has a similar model in terms of having entrepreneurial partners. Andreessen Horowitz has that. And more of these firms are providing this help. And the other thing that you're seeing, which is more typical in the US, but you're seeing more of it in Europe, is you're seeing entrepreneurs, former entrepreneurs, become actual investors, not just angels, but also venture capitalists. And I think that also brings a different perspective to the model of VC, to the patience of capital and understanding of the investment.
In terms of the contracts, I think there was a phase probably in 2009, 10, 11 where there was a lot of talk about reducing fees for venture capitalists, which I think came from kind of the private equity segment of the market. And if you have a fund of 10 billion, then I think it's the right thing to do. I think it was applied a bit too much to smaller funds as well. And I think that discussion probably left the station at this point. I think the business model in itself, nobody has deal-by-deal carries anymore. I think that's gone for a long time. I think is a fair one, because of course there's a lot of risk sharing that venture capitalists do, and then the usual carry model. I mean, there are always flavors of it, but I think that's still sound.
I guess on that, I mean, most of the venture capital firms in Europe are quite small. I think the average size is like 50 million. It's actually really hard to run a business, actually, with the fees the way it is. So usually it's very aligned with the investors. So the GPs are investing in the fund, and really the only way the GP is going to make money is on the carried interest, which is basically a result of them making money for the LPs. So I don't see any fundamental change happening there. It's obviously the big funds that have billions under management. That's where there's an issue with a conflict of interest.
The thing I do see happening, and I think this goes to everything we've talked about, which is there's more transparency, there's more data, funds are more visible to LPs now, and it's easier to benchmark. So much like we were saying that although there is volatility in the markets and there is some, let's say some capital has left the VC industry, the fact is great companies will get funded. Great funds will also always get funded. They will be able to raise their next fund, et cetera. But the weaker performers, the weaker funds will get pushed out of this market, because I think there's much greater transparency and ability to understand who's actually performing well, not just by chance, but actually by fact and by effort. I think the second thing we're really seeing a lot is at least an effort by European LPs to try to become active again. Certainly in our case, I've been, as a European, pretty flabbergasted by the lack of appetite and desire amongst European institutions, insurance companies, pension funds, and high net worth individuals to commit to tech investing. It's been a real shame, because to Tim's point, there's been actually a lot of wealth created by European tech over the last 5 to 10 years, particularly the last 5 years, and actually most of that's accrued to LPs in Asia and the US. That's a real shame. And I think you're finally beginning to see some European LPs realize that, and hopefully start to become active members of the VC community.
Good point. Does that answer the question?
Thank you. Hello, Guy Horowitz from T Capital Partners. You mentioned the ecosystem and the fact that Europe is becoming more of an ecosystem. Typically, an ecosystem is comprised of talent, which obviously there's plenty in Europe, capital, which is becoming more available, and acquisitions or acquirers who are coming often and buying stuff. You mentioned some IPOs, Tim, but there's definitely less of an M&A, especially American companies coming and buying European companies for a lot of money. Do you see that changing? Do you see those IPOs and some early exits right now making Americans a bit more interested in coming and deploying more capital here? Or will this remain a European kind of game?
I mean, I think part of it is due to really the kind of cycle we've been in, that companies thought, okay, I can score a bigger round at a bigger valuation, so I don't need to sell. I think if there is a slight cool down in the later stage markets, what we'll see more M&A. I think we've seen a bit of a pickup in the US already. But yeah, I think you're absolutely right that obviously there is still a lack of really large scale European buyers, right? There is basically no internet company in Europe above a $10 billion market cap, with maybe Zalando and United Internet or others really being the largest that you have out there. So you need these companies to at some point become more active acquirers to have a kind of inter-Europe kind of M&A theme. But I think ultimately it doesn't really matter whether it's US acquirers or European acquirers. I think what we see is more and more European companies being able to compete on global scale, and I think we all have a couple of those companies among our portfolio. So I think those companies will attract buyers from Asia, as you had with Supercell and SoftBank, or other exits, or will be acquired by US or Asian companies. So I don't think we need to just focus on European acquirers for that.
Last year we had 6 exits. We had 2 IPOs, one in London, one in Frankfurt. And out of the 4 trade sales, one was bought by a Japanese company, Swedish company, UK company, and then a US merger. So, I mean, it's not just about selling to the US buyers. Obviously, in the big deals, usually that is the case. However, as Tim mentioned, Supercell was to an Asian investor as well.
I think what's important actually and interesting is that there's roughly 10 Asian technology companies have opened offices in Europe in the last 12 months. And it's certainly something we spend a lot of time on. Our headquarters is actually in Hong Kong. And you know, when spending time with the heads of M&A and strategy at Tencent and Baidu and Alibaba, et cetera, there's been an increased awareness of the European ecosystem, a little bit of valuation driven, to your point earlier. They see a little bit more opportunity on the value side, but most importantly, just they actually see the talent, and they see companies getting bigger and bigger here in Europe, and so they're actually refocusing their efforts. And if I think over the next 5 years of who's really going to drive M&A in dollar terms, total dollar terms, I'm not sure if it's the US or Chinese companies. It might actually be Chinese companies that are deploying more dollars.
Yep.
Hi, Patrick Martin, LDA Jupiter. I have a question regarding access to capital. So there's a lot of early stage and A round funds in Europe. And then there's DST and a couple of late stage pre-IPO. But do you see a funding gap in sort of the B plus C round realm in Europe?
Anybody?
I wouldn't say so. I think, as Nenad said correctly, I think there are a couple of large funds that have 300 to 500 million or more in capital, and they're able to actually fund companies through from Series A to almost pre-IPO. Obviously, most of the time you'll form some sort of syndicate over time, but I don't necessarily see that, because we have actually a lot of, or some funds who refocus more on later stage. I think Atomico is focusing more on later stage, and you have some couple of earlier funds like Early Bird in Germany who've raised growth funds. So, and then you have new entrants like EQT, with, if they want to raise 500, then obviously they will need to invest across the stages. So, not apparent to me.
I think I would agree with Tim. And the question is, if you have a lot of companies that have been founded in an A round that actually don't deserve to be in a B round, you usually also get a lot of bickering about there's a huge lack in capital. I think we had that lack of capital probably 5 to 10 years ago. I think right now it feels like pretty balanced, and I would fully agree that there's enough capital available for great companies.
Just like so. On that point, almost every single one of our successful Series A companies is being contacted by every US later stage fund.
Right.
So if the Europeans don't get it, the US guys like Insight, Bessemer, et cetera, they're all over every single early stage European fund's portfolio. So.
The good ones, because there's not enough capital coming out of Europe for the latest.
I spend a ton of time on this because clearly I need somebody to take it through to where I can invest. So we spend a lot of time, and bluntly, I do not see any evidence of that, except in companies that have really poor unit economics and just don't deserve to be funded. So we've actually done some work around this, and I've had a guy working on it for a while, looking at those companies that have really struggled in the BC rounds. And when you really dig into the data behind it, they're either in incredibly small verticals, poor economics, unit economics, or they're number 2 or 3 in the market. And people are just saying, look, I don't want to be in the number 2 or 3. But also, the good companies with positive unit economics that are actually in decent sized sectors, I would be panicking if they weren't getting funded B and C, because there would be no business for me to exist in. So I just don't see it at all. And in fact, when we look at things like Deliveroo Funding Circle, Farfetch, Auto1, etc., even by the time it gets to DST stage, we're fighting the guys here for allocation, right? Because they're still like, this is a great company. I want to be part of it. I actually want to do at least my pro rata. And in Deliveroo, you know, the Series C was very much the insiders wanting to take part. Even the Series D that we led late last year, the insiders who had done A, B, and C still took up a large chunk of the D. So the same thing in Funding Circle, same thing in Farfetch, same thing in Auto1. So the great companies still get funding the whole way through. And in fact, the biggest problem I have is getting allocation and deals.
Yeah. On that very happy note, I think we're out of time. So I think that wraps it. Thank you very much for being with us this morning. All right. Thank you to the panelists.
Sure.